Okay, sorry. Let me start with the three apologies. First apology that I'm inflicting myself on you at this time, not my fault.
No, my
Second apology, I'm an economist, and like him, I'm going to throw some numbers and pictures at you, not as pretty as his, but I think they might be useful. And the third is that because of those numbers, I'm not going to be as optimistic as many others have been in this discussion. Okay, let me begin by sort of focusing on what I think is the core issue I'd like to raise today, which is that if you look at India's growth story, it's actually a growth story which extends for a very long period of time now. It started in the 1980s. It didn't really start with liberalization in 1991. The highest period of manufacturing growth on a sustained basis was during the 1980s, after a long period of secular stagnation. And if you look at the period after 1991, and you really look at it carefully, we had one period of growth which was starting from about 94, 95 and going on to 97, 98, which was a significant period of growth, but then came to an end, excepting for 1 year when, because of the implementation of the Pay Commission's recommendations, there was an injection of demand into the system and the economy picked up. But the second, which is what really made the Indian growth story remarkable, was a period of growth from 2003-4 to 2007-8, then a dip when we had the global crisis, and then a recovery, and now we've entered a phase in which for 2 years, possibly 3, we've had a significant slowdown in growth, a stagflation with high inflation accompanied by a slowing down of growth. And really the issue is, would that period of growth, when India got into its real high growth trajectory between 2003-4 and 2007-8, return? And to answer that question, because it matters also because that's when, in some sense, India's role within the region, India's standing in the international system, etc., began to change. And therefore, to look at that growth story and to ask whether it's possible for it to reappear, in some sense, for us to see a recovery, would be a useful exercise. Now, we must recognize, and that's what this chart really does, is that this period, 2003-4, perhaps you can't see the numbers, that if you start from the period of liberalization, really have started from the mid-1990s and go up to 2011-12, you'll notice that as far as India being an attractive destination for foreign investment, there was a dramatic change which occurred in 2002-2003. Starting from 2003-4, you can see those bars, they really jump. There is a huge increase both in terms of direct investment flows as well as portfolio investment flows. So coinciding with the period in which we had this high growth, we had a substantial increase in the inflows of foreign capital into the system. Now, in many ways, and I don't want to go into it, but what it does because of secondary market trading, which converts dollars into rupees in order to buy equity, what it does in terms of forcing the Reserve Bank to buy foreign exchange in order to prevent the rupee from appreciating and therefore injects liquidity into the system. In many ways, when you have a sudden capital surge of this kind, there's a huge increase in liquidity in the system. And I think we need to keep that in mind when we're asking the question, what really happened in this period from 2003, which seemed to make India the next miracle among developing countries. I have a friend who says that the only place outside the Vatican where you see more miracles is in the developing world. You used to see it in Latin America, then we saw it in East Asia, then we saw it in China, and then people started saying, till 2 years back, that we are seeing it in India. Now if you look at that surge, it has two characteristics which I'll briefly touch on. One, of course, it was not a surge which was restricted to India. There was a huge increase in cross-border flows globally in the period after 2003-4. But India did get a significant share of that flow, a disproportionate share, you can say. India became in part the flavor of the season because of a decision which was taken, I would argue, in the budget of 2003-4, where the government of India decided that if an investor, foreign or domestic, invests in the stock market, holds an equity for 366 days, that is more than 1 year, and makes any profit, it could be 10%, it could be 20%, it could be 60%, it could be 80%, you don't pay any capital gains tax. Now, this is not true even in a country like the United States, where you have to pay a minimum of 15%. So it's not merely that we had a Mauritius route, which made it possible to avoid capital gains by investing in India because of the agreement we had, but you actually made the Indian stock market into a bit of a tax haven so long as you were willing to hold your equity investment for at least 366 days. So while there was a global phenomenon which resulted in this flow, the disproportionate flow of that capital into India was partly the result of the fact that the Indian government went out of its way in 2003-04 to actually create what is, in essence, a tax haven as far as the stock market or the equity market is concerned. Now, why does this matter? Now, why this matters is, if we look at the same period and you look at commercial bank credit as a proportion of GDP in India, that the middle of that set of bars corresponds to 2002-2003. So what you actually see is that between 2002-2003 and something like 2007, 2008, 2008, 2009, the ratio of outstanding scheduled commercial bank credit relative to GDP increased in India from 26% to 52%. That is, the banking system was injecting a huge amount of credit based on the liquidity which the system was generating in order to be able to expand credit in a huge way. Now, when that credit expanded, what you really had is two areas I'd focus on. There were three, but I'll just take two. Two areas mattered from the point of view of what happened to demand in the domestic system. One, of course, is that we saw a substantial increase in what the banking system calls retail loans. Retail loans are personal loans for housing, personal loans for purchases of automobiles, personal loans for buying consumer durables, credit card receivables, personal loans for education, you name it. All of that put together constitutes the retail loan sector. In the early 1980s, out of the total bank advances in this country, something like 4% of credit was in the form of retail credit to the personal loan sector. If you come to 2002-03, 2003-04, something like 8% of total bank advances was in the form of retail loans. By the time you get to 2007-08, something like 23% of total credit advanced by the commercial banking system was to the retail loan sector. That is, like happened at during the subprime years in the United States, for example, what you had is this liquidity which was there in the system was partly being directed in the form of credit, which was resulting in a substantial increase in demand, credit finance, private credit finance demand for housing, for automobile purchases, for durable purchases, for credit card spending, etc., and that obviously does something to growth. Now, this is important because this was the period we must recognize when India actually began to implement its commitment, or the Indian government, to rein in the fiscal deficit. So that if you look at the fiscal deficit to GDP ratio, those were the years, of course it's changed ever since the crisis, those were the years when we saw a significant reduction in the fiscal deficit of the government of India relative to GDP. So what you're actually seeing in a larger picture is the substitution of private credit finance demand, or credit finance private demand as a stimulus to growth for credit finance public expenditure as a stimulus to growth, which is what happened in the 1980s when India overborrowed, the Indian government overborrowed. I have a graph there, huge increase in public debt, but what you really had is the substitution. The second, which I said, there was a second area to which it went. I'm sorry about this graph. But what this graph actually says is that one result of this increase in private credit is that if you look at that large maroonish segment, that was the segment which reflects lending to industry, and the bottom blue is lending to agriculture. That is, overall, you're seeing a squeeze in the financing of the commodity producing or the productive sectors of the economy in this period. So you will say, oh my God, so there's a shift. You're moving to the demand side from the supply side. However, remember, this is a period when credit to GDP ratios have gone up from 26% to 52% in a period when the Indian economy is growing at the rate of 8 to 9% per annum. So there's a huge increase in credit. So even if you're squeezing that, you're actually giving out a large volume of credit. Which industries are you giving this credit to? If you actually look at it, what you find is that during this period, lending to what is called infrastructure went up hugely. It went up from 2% in 1998 of total bank lending to industry, that segment, to something like 31.5% of total bank lending to industry went to infrastructure in 2012. Now, why does this matter? Normally, banks don't lend to infrastructure. The reason they don't lend to infrastructure is that the nature of banks is they get small deposits from a large number of people who don't want interest rate or capital risk, who want liquidity. And something might happen. There might be an illness in the family. The child get married. You want to put somebody into school or college or whatever it is, and you go to the bank and say, "Give me back my money." So you want liquidity besides low risk. Now, if the bank takes that kind of money and lends to infrastructure, this is an area where investments are lumpy. It tends to be relatively higher risk, both in a return sense and in a capital sense, and of course, it's illiquid. If you're having a problem in the Gurgaon tollway, you can't actually pick up the tollway and go and sell it and take your cash back. It's very difficult to do that. You'll have to find a buyer who's willing to come in. So when you see this kind of a shift, obviously you're asking yourself the question, why this sudden entry in this huge way from something like 2% to 32%? And what you actually find is that if you break this down, the lending has gone to power. The lending has gone to telecom, that's the second one. It's gone to roads and ports. And then it's gone to other infrastructure, much of which is lending to civil aviation. We, for example, know today that Kingfisher is closed down. The people who are getting hit the most besides the workers is, of course, the banking system, because there's huge exposure of the banking system in particular. Which are the banks which are lending to infrastructure? It's the public banking system. Because, in fact, if you look at the foreign banks, they've cut back even the little lending they had to infrastructure because they don't want that exposure. So what you implicitly seem to be having during this period of high growth is that using the liquidity which came into the banking system, the state pushes public sector banks to finance infrastructure investment, which it is not financing, even though that means a high degree of risk and instability for the banking system. Now, what I'm going to say, since I think I'm running out of time, is that if you take just these two, and there are others I can go into, but just take these two. One, a huge increase in exposure to the retail lending sector. Tharapore, S.S. Tharapore, who was the person who chaired 2 committees on capital account convertibility, actually made the statement that, listen, why 2 years back, why are we all sitting down and talking about the subprime crisis in the United States? India is sitting on its own 400 billion rupee subprime time bomb, is what Tharapore said at that point of time. So there is one area of risk into which you go. And as a second area of risk into which you've gone, you've entered into an area in which there's very high risk. This is besides lending to finance, to the stock market, to commercial real estate, etc. Now, if you have a situation of this kind, we know that if there is even the beginnings of a downturn, then obviously banks are going to begin to get hit. And we are seeing it. We are seeing it to a certain extent in telecom. We're going to see it. We've seen it very significantly in civil aviation. We're going to see it very soon in power, because if those power projects have to be profitable, tariffs have to be set at a level which is going to be a major political problem, both for the distribution companies and for the state. And therefore, you're actually going to see a significant contraction in the use of liquidity, even if you get it, in order to be able to sustain this kind of a private, debt-financed consumption and investment boom in infrastructure, in this case, which has sustained that period of growth. Which is why, actually, you have simultaneously so many things happening. Simultaneously, you're having a situation in which the banks are beginning to have to restructure loans. If you look at what the banks claim are their non-performing assets, it's collapsed. But if you look at the assets, I'm sorry about that, if you look at the assets which are restructured, that is, in 2010, for example, Kingfisher goes to the banks and says, listen, I can't pay you. So the bank says, okay, let's not write off your loan. We'll restructure your loan. We'll change the maturity period. We'll change the terms. We'll give you new lending. And we know that 2 years down the line, things are as bad. Now, if you look at restructured assets as a part of the advances of the banking system, it had gone up from about 2.7% in 2009 to something like 4.7%. That doesn't appear as a non-performing asset. But if you look at the declared non-performing assets of the banking system, it was at 2.4%, it's at 2.9%. We really don't seem to be having any problems in the banking system, as the central bank tells us. But that's because, as the Financial Times, the London Economist, everybody's recognized. Now, you've restructured a set of your assets which constitutes the most painful assets. So therefore, you're going to have a pullback in terms of lending. That affects growth. When it affects growth, you obviously have foreign firms being less willing to come in. That affects the value of the rupee. That affects the inflow of capital. That affects liquidity in the system. So you actually seem to be in a situation where, unless we move out of the kind of growth strategy we had between 2003-04 and 2007-08, we can't get back to that growth rate. But then, what is going to be that alternative strategy? As of now, we seem to have only one. Keep thinking of new reforms which can attract foreign investment to come in, retail, multi-brand retail, pension fund industry, insurance. Try a hand at everything and hope that that liquidity will come, that foreign investment will keep coming, the liquidity will be there, banks will be willing still or can be pushed still to undertake this lending, and we can sustain this growth. We are not at the moment looking at an alternative, and if the downturn, which is just now 2 to 3 years old, is indicative of what went wrong with the 2003 to 2008 strategy, then I think it is a turning point in which the optimism that India can constitute a game changer of the kind that maybe China will is, I think, something which has to be based on political factors maybe, but definitely not on the fact that it can sustain this kind of a high growth story. Thank you.